Have you ever wondered where to invest your money in 2024? Welcome to the world of investments, a vast landscape filled with opportunities waiting to be discovered. Today we're going to explore 10 key assets that everyone should consider investing in. In an unpredictable financial climate, diversifying your investments is more crucial than ever. This means spreading your money across different types of assets to balance potential risks and rewards. From traditional assets like stocks and bonds to more contemporary ones like cryptocurrencies, each asset offers unique benefits. Real estate, mutual funds, precious metals, ETFs, peer-to-peer lending, art, collectibles and index funds, these are the 10 assets we'll be delving into. Each one carries its own potential for growth, security and wealth creation. Whether you're looking to grow your wealth, secure your financial future or simply explore new investment avenues, these assets can provide the solutions you need. So, are you ready to discover the 10 assets you should consider investing in this year? First on our list, stocks, a popular choice for many. So, what are stocks? Simply put, stocks represent ownership in a company. When you purchase a stock, you are buying a piece of that company, becoming a shareholder. Now, you might be wondering, why invest in stocks? The potential for high returns is a big draw. As a company grows and becomes more profitable, so does the value of your stock. Sounds great, right? But remember, the potential for high returns comes with risk. Stocks can be volatile, with prices fluctuating based on market conditions and company performance. That's why it's crucial to do your homework. Understand the company you're investing in, its business model, its financial health, and its potential for future growth. Investing in stocks is not just about buying low and selling high. It's about supporting companies you believe in and want to see succeed. Stocks can be a rewarding investment, but remember, they require research and understanding. Next up, bonds, a safer harbor for your money. Let's dive into the world of bonds. Essentially, they're loans where you play the bank. When you buy a bond, you're lending your money to an entity, like a government or a corporation. In return, they promise to pay you back with interest, providing a steady stream of income. Bonds tend to be less risky than stocks, but they also offer lower returns. They're a great choice if you're looking for more stability in your portfolio. Now, there are three main types of bonds you should know about. Government bonds, often considered the safest, are issued by national governments. Municipal bonds issued by local governments often come with tax benefits. And then there are corporate bonds issued by companies. These can offer higher returns, but also come with higher risk. So bonds, a safer but slower growing investment option. Moving on to mutual funds, a basket of various investments. Imagine walking into a supermarket and buying a basket of groceries instead of selecting each item individually. That's the essence of mutual funds. They are investment vehicles that pool money from many investors to purchase a diverse range of stocks, bonds or other assets. This gives you, the investor, the advantage of diversification, spreading out the risk across multiple investments. But let's not forget about the fund managers. They are the ones who decide what goes into that basket. Their expertise and research guide the fund's investment strategy, aiming to generate good returns. However, this service isn't free. All mutual funds come with fees, often a percentage of your investment, which cover the cost of managing the fund. So, in the world of investments, mutual funds stand out as a diversified option. They combine the knowledge of expert managers with a wide range of assets, offering potential for good returns. Mutual funds, a diversified option with potential for good returns. Now, let's talk about real estate, a tangible investment. Real estate investment can be a gateway to financial freedom. It's an asset class that has the potential to provide you with a steady stream of income through rentals. Plus, the value of your property could increase over time, making it a solid long-term investment. But like any investment, it's not without its drawbacks. Real estate requires a significant initial capital outlay. Plus, as a property owner, you'll be responsible for ongoing costs like maintenance, repairs, and taxes. And let's not forget the market fluctuations. The value of your property can go up and down, so there's always a level of risk involved. However, if you're willing to take on these responsibilities and risks, real estate can be a rewarding investment. It's not just about the potential monetary returns, it's also about the satisfaction of owning a piece of the world. Real estate, a tangible asset with potential for long-term growth. Next, cryptocurrencies, the digital gold of our era. Imagine a type of currency that exists purely in a digital form, untethered from any physical entity. That's what cryptocurrencies are. Born from complex algorithms and cryptographic techniques, they've revolutionized the way we perceive value and transactions. What makes them attractive is their potential for high returns. With their high volatility, they can skyrocket in value within a short span of time. But remember, with great potential comes great risk. The same volatility that can lead to high returns can also lead to significant losses. It's like riding a roller coaster, thrilling, but not for the faint-hearted. Before you dive into the world of cryptocurrencies, it's crucial to understand the technology behind it. Blockchain, the underlying technology, is as important as the currency it supports. It's the backbone of the system, ensuring security and transparency. Cryptocurrencies, a high-risk, high-reward digital asset. Gold and precious metals, the classic store of value. Let's take a moment to appreciate the enduring allure of these shiny commodities. They've been cherished since ancient times, not just for their beauty, but for their inherent value. What makes them an attractive investment today? In times of economic uncertainty, gold and precious metals often act as a safety net. They tend to maintain their value even when stock markets are in turmoil. This makes them a reliable asset to have in your investment portfolio for those stormy financial weather days. Moreover, they serve as a hedge against inflation. When the cost of living rises, so does the price of gold and precious metals. This provides a measure of protection for your investment, helping you to preserve your purchasing power in the face of rising prices. So, whether you're a seasoned investor or just starting out, don't underestimate the golden opportunity that lies in gold and precious metals. Gold and precious metals are classic but stable investment. ETFs, a popular choice for diversification. ETFs, or exchange-traded funds, are essentially a basket of different investments. Think of them as a mixed fruit basket, where each fruit represents a different asset. They are traded on stock exchanges just like individual stocks, hence the name. One of the significant advantages of ETFs is diversification. Instead of buying a single apple or orange, you're purchasing a whole basket of different fruits. This spreads the risk and can potentially increase your returns. ETFs also tend to have lower fees than other investment vehicles, making them a cost-effective option. Choosing an ETF, however, requires some homework. Look at the fund's composition, its past performance, the fees involved, and the reputation of the fund manager. Remember, the goal is not to chase the highest returns blindly, but to align your investment with your financial goals and risk tolerance. ETFs, a diversified and cost-effective investment option. Peer-to-peer lending, a modern way to earn interest. Welcome to the world of peer-to-peer or P2P lending, a space where you can play the banker. In this investment strategy, you lend money directly to individuals or small businesses through online platforms that match lenders with borrowers. This process cuts out traditional financial institutions, and typically both parties benefit. Borrowers can secure loans at competitive interest rates, while lenders receive the interest payments, which often surpass those of standard savings accounts. However, it's not all roses. P2P lending comes with its own set of risks, including the potential for borrower default. To mitigate this risk, diversification is key. Spread your investments across multiple loans rather than putting all your eggs in one basket. The platforms themselves play a vital role in facilitating these transactions, vetting borrowers, setting interest rates, and managing loan repayments. So, remember to choose wisely. Peer-to-peer lending, a modern and potentially lucrative investment. Art and collectibles, investing in passion and rarity. When you invest in art and collectibles, you're not just buying an object, you're buying a piece of history, a story, and the potential for high returns. It's like owning a piece of the artist's soul, a tangible representation of creativity and talent. However, this asset class isn't for the faint of heart. It requires an eye for quality, an understanding of market trends, and a knack for spotting authenticity. Forgeries are a serious concern in this space, and the value of a piece can change dramatically based on its provenance and condition. Determining the value of art and collectibles can also be challenging. Unlike stocks or bonds, there's no ticker symbol to track their price. Valuation often comes down to expert opinion, recent auction results, and market demand. Despite these challenges, the potential for high returns can be substantial. After all, a Picasso or a vintage Ferrari isn't made every day. Art and collectibles, a unique but potentially rewarding investment. Last but not least, index funds, a passive but effective investment. Imagine a basket, but instead of fruits, it's filled with assorted stocks or bonds. That's what an index fund is. It's a type of mutual fund or exchange-traded fund with a portfolio constructed to match or track a particular market index. Here's how it works. The fund manager of an index fund doesn't pick and choose investments based on their potential. Instead, they mimic the components of a specific index, such as the S&P 500. This approach means that the fund will perform in line with the market it's tracking, taking the guesswork out of investing. The benefits? Well, because index funds are passively managed, they often come with lower fees than actively managed funds. Plus, they provide broad market exposure, reducing the risk of having all your eggs in one basket. For beginners looking to dip their toes into the investment pool, index funds can be a great starting point. They offer a balanced blend of risk and reward with the added perk of simplicity. Index funds, a simple, passive but effective way to invest. So there you have it, 10 assets to consider investing in 2024. Let's quickly recap. Stocks, offering potential high returns, bonds for steady income, mutual funds for professional management of your investment, real estate, a tangible asset that can appreciate over time, cryptocurrencies, the digital frontier of finance, gold and other precious metals, a safe haven in uncertain times, ETFs for diversified exposure to different sectors, peer-to-peer lending for higher potential returns, art and collectibles, unique assets that can appreciate in value, and lastly, index funds, a simple way to gain broad market exposure. As we wrap up, it's important to remember that each of these assets comes with its own set of risks and rewards. Take time to do your own research and consider what aligns best with your financial goals and risk tolerance. Remember, investing wisely requires knowledge, patience, and diversification. Make your money work for you in 2024.